Dear viewers, welcome to this edition of Your Life, Your Money. What is that I'm going to speak to you in this episode? In this episode, I'm going to talk to you about two asset classes, the mutual funds versus fractional commercial real estate. I'm going to discuss the assets in detail. I'll be discussing the merits, demerits, advantages and disadvantages of investing in these two asset classes. This is NRI Money Clinic for you, and I'm Dr. Chandrakant Bhatt, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, before I start with my presentation of today, fractional commercial real estate versus mutual fund, let me explain to you why I'm doing this. The idea here is to know if I compare one asset class with the another asset class, how does it look like? It is not an attempt to arrive at a decision to say mutual fund is better, fractional commercial real estate is better, you should use only this or you should do only this. That is not the idea here. The idea here is to know both these asset classes compared with one another. When this comparison is done, then you have facts and figures in front of you. Take a proper decision how much of which asset class should go into your portfolio. Dear viewers, before I present you this particular topic of comparing fractional commercial real estate versus the mutual funds, let me add a disclaimer here. Whenever I mention about mutual fund, I am referring to a properly constructed, scientifically designed mutual fund portfolio. I am not referring to any single schemes, any single market cap like a large cap or a flexi cap or a small cap or a mid cap. I am referring to a portfolio of mutual fund designed to reach your life goal. Likewise, when it comes to question of fractional commercial real estate, I specifically refer to ready to occupy grade A properties. Your tenant should be a corporate. These should be pre-leased, and when you invest your money, the rent should start immediately. This has nothing to do with any other form of real estate, be it residential real estate or be it funding the builders through payment plans. No, that's not what I mean to in the case of fractional commercial real estate. These are the ones where the rent should start immediately. Hope I am clear on this disclaimer here. To compare any asset class, we should have a matrix against which this can be compared. I have picked 6 metrics for comparison between a mutual fund and a fractional commercial real estate. What are the 6 metrics? Number 1, the return potential. Number 2, the safety features. Number 3, volatility. Number 4, liquidity. Number 5, entry level barriers. Number 6, the taxation. So these 6 aspects will be taken and we will compare these two asset classes. First, let me take up the mutual fund separately, and then I'll talk about the fractional commercial real estate and then make a comparison on it. First, let us look at the mutual funds. How do you get returns from mutual funds? The returns from mutual funds invariably comes from capital appreciation. It is not that the mutual fund pays you a certain amount of money like a bank interest or a dividend or a rent. All the gains from mutual funds will come in the form of capital appreciation. So the capital appreciation, when it will happen, how much it happens, it has no measure of time or no measure of how much return it can give. In a short span of time, your mutual fund portfolio may generate a very high rate of return. On the contrary, it can also go through a very volatile phase where the invested amount can also go down in its value. Both possibilities exist, but the mutual fund in the long run will invariably give you a high rate of return. In case of Indian context, in the last 10, 20, 30 years period of time, the history says the mutual fund portfolios have generated somewhere between 12 to 14% depending on what has gone into construction of your mutual funds. One thing stands out. One, it requires a long period of time. And in the long period of time, it is invariably going to beat the inflation. It is very safe to assume, based on what has happened in the past and based on a common sense, to expect the mutual fund portfolios to generate somewhere between 3 to 6% over and above the bank FD rates. I have told in multiple videos the FD rates are linked to inflation. If the portfolio beats The bank FD rate, it means it is beating inflation, so it will beat anywhere from 3 to 6% at any point of time in future from the bank FD rate. So it's a great investment tool from the point of view of returns. What about safety of mutual fund? Mutual funds are pretty safe, but it is conditional. The conditional is that when you invest in mutual fund, you cannot see what happens in the short term. In the short term, it may move up, it may remain static, it may fall down, all possibilities exist. So the safety of your investment in a mutual fund portfolio is dependent on time. The more the time you give, more safer it becomes. In the short term, anything can happen. Likewise, how do you enter a mutual fund will also dictate how safe it could be. For example, if you are entering at a peak market conditions, like what happened in case of 2007 or any peak market or a peak bull run, then you are exposing yourself to a little bit of a risk around that time, and it may take a long time for your portfolios to capture its value all over again. So the time of entry is also very important. Likewise, the stage of the market is also very important. If you are entering the market when the markets have corrected, it may remain very safe. If you have entered when the markets are peak, it may take long time if the markets were to correct on that. It also depends on the purchases that you make. I mentioned to you about the mutual fund portfolio, but if an individual investors were to pick up individual funds, what you buy can also dictate the safety. See, in 2007, infrastructure funds were in great demand. There were a lot of NFOs which came in. But what happened subsequently? People who invested money in the infrastructure funds did not recover this money for decades together. It's not just a few years. So what you buy will also dictate how safe the asset can remain for you. So safety, yes, on a long-term platform, the monies will remain safe, but condition says you must have time, you should control your entry points, and you should control what you buy. Then the mutual funds can also be safe. Look at the liquidity of the mutual fund. There is nothing which can be more liquid than a mutual fund. If you are parked your money in a mutual fund, if the stock markets are working, which is 5 days a week, you can exit your portfolios and you can get your money. So liquidity, I would say mutual fund scores highest. So you have nothing to worry about that, and liquidity is at will. Volatility. Volatility is the asset prices moving up and down. In case of a mutual fund, one thing is certain, the asset is very volatile. You cannot say that I have earned so much of money, so I have made so much of money. You do not know what will happen next week or next month or next year. So the asset is volatile in nature. So you may say I have got a valuation today, but the same valuation remaining at a future point of time cannot be predicted. So it's an asset which is volatile. Volatility can move up and down both ways. So in the long run, your portfolios move up, you get good returns out of that, but asset will remain volatile. The next parameter to compare is entry level barrier. Mutual funds have no entry level barrier. Anyone can invest in a mutual fund as long as you have got a PAN card, you have got a bank account, you have done your KYC. Any person can invest in mutual fund with as little as 500 rupees or 1000 rupees. You can invest your money in mutual fund. I have got a large chunk of money. Yes, you can enter. I have got streaks of income. You can enter. I have very limited amount of money. I can enter. I have received some money in the form of gift. I can do it. I can enter as a lump sum, a regular investor. You name it. There is literally zero entry level barriers in case of mutual funds. Taxation. If you are invested in the equity related mutual funds, they will have capital gains structure as a tax form. So for long-term investors, the capital gains just works out to about 10%. If you are invested in the debt funds of the mutual funds, so the gains will be treated as your short-term capital gains tax, which means to say it gets added to your income of the year and taxed accordingly. Now let us compare fractional commercial real estate against the same 6 metrics. First, returns. In case of mutual funds, you observe that the returns are coming in the form of capital appreciation. What is the story with fractional commercial real estate? Here in this case, the returns will come in 2 forms. Number 1, the rents, which is a cash flow. Number 2 is the capital appreciation. So the returns will come as rentals plus the capital appreciation. Very interesting story here. The cash flow you get is very real. Capital appreciation is always a mirage. It depends on circumstances, it depends on the willingness of the person on the other side to buy the asset, irrespective of the asset. So capital appreciation is always an if, the cash flow you get is always real. Most of the gain from fractional commercial real estate comes in the form of rentals. There are many videos I have produced on this particular subject. The total returns you get from fractional commercial real estate is approximately in the range of 12 to 14%, which is same as a mutual fund. But the beauty is 8 to 9% out of this 12 to 14%, which is total, is coming in the form of rentals. That means it is a real gain, and this is the gain which you see in your bank account month after month. And the remaining money will come in the form of capital appreciation. Very interesting story also to add here is the rent what you get is almost inflation proof. The rents you get will rise by about 5% every year or 15% once in 3 years. Ultimately it boils down to same 5% per year. So that means your cash flow is rising, inflation is picking up, and the cash flow you are getting is getting adjusted easily to the inflation. And when your asset starts giving you 5% more rentals, it is absolutely obvious to expect the capital appreciation will also happen. Otherwise, the cash yields will rise very fast. The rental yields will rise very fast. So the capital appreciation, while we say is an if, because of the rising rentals, the capital appreciation also will move out of an if, and it is bound to move through a capital appreciation route without any doubt. So it's fair to expect if the rents rise by 5%, the capital appreciation will also happen by 5%. So if you get 8% in the form of rentals, 5% by way of capital appreciation, your returns will remain same in case of fractional real estate when I compare it with mutual fund. But it is less volatile because you get rent after month after the month. So there is no question of if here, it is bound to happen. The next metric we have to look at is safety. We discussed safety in case of mutual fund. In my personal opinion, I personally feel fractional commercial real estate for me appears to be more safer. It is safer because you are getting into large commercial assets. Your tenants are corporates, and these assets are in the high demand areas. So the probability of even if one tenant were to leave, finding another tenant will become easier. Let's say you have bought a commercial real estate in some nook and corner of a village, then it becomes a problem. But if you are in a central business district and the asset size is very large, it could be a corporate office, it could be a warehouse project, it could be a hospital structure, it could be a business hotel, it is always possible to find another tenant. So for me, it looks more safer than the mutual fund itself, and you keep getting the rentals month after month. Since you are dealing with an institution, a corporate, these corporates not paying you rents, unlike in case of individuals, is very, very remote. So it looks much safer for me. What is that risk that we look at in case of fractional commercial real estate? For me, the only risk that I feel in case of fractional commercial real estate is period of dryness, or called the dry period. Let's say if one corporate were to leave from this premises, until the asset management company finds another tenant, you may not get a rent during that particular period. This is the real risk in case of fractional commercial real estate. Otherwise, if there is no tenant, you still have got that particular asset which is there in your name. So safety wise, fractional commercial real estate scores far, far higher in my personal opinion. Let's look at the third metrics of volatility. There is zero volatility in this because it is not linked on the stock markets. There is no daily pricing of your asset. So there is no volatility. So you quote a price, that price is there. Whether you find a buyer or not is secondary. Likewise, you have fixed a rent and the rents keep coming to your account month after month as per the contract. So the volatility aspect in this case is zero. Let's look at the liquidity. The liquidity is a factor that needs to be considered when you commit your money into buying fractional commercial real estate. Unlike in case of mutual fund, which is 100% liquid, in case of fractional commercial real estate, liquidity remains an issue. If you buy a portion of fractional commercial real estate today, for next 1 year, you cannot sell it. After 1 year, you can make known your intention to sell the asset and you can list it under the platform where you have purchased from, and there are always buyers. Likewise, after 5-6 years, usually the asset management companies themselves will come with an offer to state that your asset has gone through so much of a capital appreciation. If all of you agree on, they are prepared to sell it off and give you another asset in lieu of this. So that is another way you exit. So either you should make known your intention to sell this and inform it on the platform on a resale, or the asset management company itself can give you a liquidity after 5, 6, 7 years, depending on what happens in the real estate. So the liquidity aspect remains an issue in case of fractional commercial real estate. What about the entry level barrier? In case of mutual fund, you can enter with as little as 500 rupees or 1000 rupees. But to enter real estate per se, you require large amount of money. Fractional commercial real estate has solved this problem to a great extent, but nevertheless, even in case of fractional commercial real estate, this is not for everyone. The minimum ticket size in this particular case is 25 lakhs. Unless you have so much of 25 lakhs of funds available to you, you cannot enter the fractional commercial real estate. How does the taxation work out? In case of taxation, the rents you collect from this investment in asset is taxed as per your income. So the rent you get gets added to your income of the year, and on an accrual basis it gets taxed. If you are at 0% tax, you don't have to pay any taxes. If you are at a 30% tax bracket, you have to pay at appropriate 30% tax bracket. The return that you get in the form of capital appreciation, that means whenever you sell this asset on your own or the asset management company exits your asset, then it will be treated as gains from unlisted shares, which gets taxed at about 20%. So on a taxation matrix, fractional commercial real estate, you have to pay slightly higher taxation than when it is compared with mutual funds. Now the crucial question is, we have discussed these two assets. Which asset is better for you? I do not have an answer. Both the assets are good. Each one scores on certain metrics, another scores on some other metric. Both give you similar rate of return. One gives you return in the form of capital appreciation, another gives you a cash flow plus capital appreciation. Both are worthy of investment. I personally believe that every investor should have both in their portfolios, not only A, not only B. Depending on your individual circumstances, your risk profiling, what you are looking for, you can combine both these assets in your portfolio. The thing that you should avoid is going overboard on only one. Don't fall in love with any asset class. Whether it's an FD or a mutual fund or a fractional commercial real estate, don't come to a conclusion to state that I favor this party and I favor that party. No, that's not the way you have to approach it. Approach in such a way that you have exposure to both these asset classes. Likewise, do not fall in love with these things. Don't get into impulsive buying. Don't get carried away by advertisement. Don't get carried away by what you see on the television. Take always the help of advisors and arrive at what you should buy, how much you should buy, when should you buy, which way you should enter this. That's the rational way of approaching these two asset classes. Now let us look at who can use these two asset classes. Now if I look at any age group, there is a possibility that you can incorporate both these assets in your portfolios. If you were to be a retired person looking for cash flow arrangements, then you should definitely use fractional commercial real estate. Only thing that you have to keep in mind here is you should not overexpose yourself into this asset class. My personal opinion is that if you have, let's say, 1 crore of retirement corpus, do not expose more than 30% of your monies into fractional commercial real estate. You get a sustainable cash flow, your cash flow keeps improving year after year, and you are keeping a smaller exposure into it, and tomorrow if you don't want to sit with this asset, you can dispose of this asset and you can realize the monetized or the appreciated value of this particular property. Nevertheless, the retirees must also have the mutual fund portfolio, which is designed for their specific needs, comprising of both debt funds, hybrids and equity portfolio. If you are a pre-retiree, 45 years and above till the day you retire, then this is a great time for you to build your cash flows for your retired life. Start building on the fractional commercial real estate right now. You are still working and you will still have the cash, and by the time you retire, you can derive a good amount of cash flow to support you during your retirement life. Nevertheless, you too must have a good amount of money in your mutual fund portfolio. If you are a youngster, what should you do? Youngsters primarily have a need for wealth building. The mutual fund portfolio should occupy a disproportionately higher amount of space in your investment portfolio. What is the role of fractional commercial real estate here? Number one, as an youngsters, you may or may not have the amount of money you require to buy a fractional commercial real estate. And if you have that money, it can support you as a second income. If you build a second income strategy, fractional commercial real estate fits very well into your portfolio. One of the drawbacks the youngsters will feel in this case of fractional commercial real estate is because it gives out cash to you immediately after investment, you could be already in a higher tax slab. The rents you get from this fractional commercial real estate is added to your salary income, and you are required to pay the applicable taxes on the rents that you collect. This is a point that you have to keep in mind. But nevertheless, for every category of people, both these asset classes are very relevant. Both asset classes will give you similar rate of return. If you are a person who is looking to generate a cash flow, tilt toward fractional commercial real estate. If you are a person who is looking for a long-term capital appreciation, then tilt towards mutual fund. That is the best strategy for all of you to adopt. Well, dear viewers, how can we help you as NRI Money Clinic? We have team of experts who work on mutual fund portfolios, as well as people who have an expertise on fractional commercial real estate to help you. If you want to invest in mutual funds or through the fractional commercial real estate, you can make best use of services provided by NRI Money Clinic. All that you have to do is look for our number in the description box, or we have already given a link over there. Click on the link, it takes you to our WhatsApp. Send us that message now with your interest, and my team of experts are ever ready to help you. Send that message now. Dear viewers, hope the video that I have done today helped you to understand mutual funds versus fractional commercial real estate, points that you have to keep in mind before you buy into any of these asset classes. If it did give you a direction which you should take, please give me a thumbs up. If you are a person who is watching my channel for the first time, or if you are yet to subscribe for the channel, please hit the subscribe button and press the bell icon. Do not forget to share these videos with your near and dear ones, friends and relatives, and on all the WhatsApp group on which you are connected with. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another topic in yet another video. Till then, stay safe. Jai Bharat.
Press the bell icon for more details and subscribe our channel.